so much, everyone, for being here and being here on time. We really appreciate you guys. Full of things. We are first off, obviously, going to be going over how we're going to get our clients off the fence and into the market. Imagine that's probably a little bit of a pain point for all of us here. A lot of people telling us we're just going to wait. We're going to wait for whatever the case may be. So we're going to address some of those things, address some of the concerns that buyers are expressing right now, and some ways to work around that. So with me, obviously, I have my wonderful sales manager, and for those of you who don't know, which everyone in here knows, well, I'm a wonderful mother, Jeanette Hartman.
But look at the best part.
I went from the best.
Like it says presented by Tyler Webb. So guess what that means? Like he's in charge. I can sit down. That's your goal. And then I'll just interject every once in a while when
Let me sit there. Yes. So awesome. Well, thank you guys so much again. And first, I want to start off. This will work for me, maybe. Maybe. Should I plug it in? Well, you know what? It helps if I actually click on. There we go. Cool. First off, little icebreaker. Back to college days here. Turn to the people next to you. Talk about what is the best thing that's happened to you recently. Just a couple of minutes here. Go ahead and share that. It could be the last week, 2 weeks. Go.
But well, I'm still getting fees. And that issue. Is when it made sometimes
We'll get to that. Circling back in here. Awesome. Right. Anyone want to raise their hand? They feel like they have the best thing that happened to them recently. There we go. We'll take that. I envy you. That's what the weekend hopefully might be for, you know. So awesome. Anyone else?
this life.
There we go.
We had a great trip to Hawaii.
There you go.
And my team told everything while I was gone.
There we go.
It's right now, like,
yeah, but it's
which I now.
We did a lot of family vacations where I wake up and they're, you know, my grandparents, my stepdad, so we come out and they're both on their laptops answering emails and in Compass, working on loans. And I'm like, okay, you know, now that I'm in it, I'm like, oh, I understand. So being off the computer, that's a really big win. Ali, I know you've got a really good one.
That's actually my first transaction, same too. So it's awesome. That is a big story. And I got one.
Yeah.
One of our girls in.
Yeah. You've been working her for what, a year? Yep. And then really quick on Ali's, he was one of the very few who got the temporary buy down with it, which was awesome. Because they literally came out Calf and said, oh, we're not doing that anymore. And he was one of the very few that got locked with it. So
He was one of the last ones that got locked.
probably one of the only, like, I don't know how many people actually got both of those things combined. But anyways, thank you so much for sharing and indulging in that little icebreaker. That feel a little bit better than how are you? right? A little bit more in depth, getting a little bit more insightful. Awesome. Well, we're going to talk a little bit more about that here in just a little bit. Couple of things here, some housekeeping rules. Silence your cell phones, please. If you have to take a call, I totally understand. Just hop out there, step away. That way we don't all listen in. Raise your hand if you guys have a question. If you're on Zoom, which looks like we're a little low on that right now, if they come in, they'll stay muted because that's how we set it up. And yeah, we are recording this, so we'll send a copy to everyone afterwards. So just give us a little bit of time to get it processed, polished up. I apologize for those of you who were at the Dream for All one, Dream for Some. Literally, as soon as we got rolling with it, we did not have time to get it processed, polished, and everything before it was over. So we're like, exactly. So, all right, so the first thing here we're going to be talking about is tackling affordability pains. How can we address their concerns? Because obviously there are a lot right now. It's a weird market. I mean, every market's a little bit weird here, but how can we specifically address these concerns that they're having? So first, I want to address the elephant in the room, which is the LLPAs. Raise your hand if you have heard in the last 2 weeks, you should trash your credit because you're going to get a better rate. Perfect. So that is completely false. Of course, the media is just spinning this thing out of control. We're hearing things from you should put down as little as possible and trash your credit for the best rate possible to what's actually correct. And we'll go into that here in just a sec. So, and I want to keep this relatively brief because we could do a whole presentation on the LLPA changes. But first thing, the old LLPAs looked like this. This is a giant chart of numbers that don't expect you to really take a whole lot of notice to. But really what you can look at here is this is a higher down payment over here. This is a lower down payment over here, lower credit down here, higher credit up here. These zeros we want to see, zeros, negative numbers, those are credits or par rates. So they're not getting charged if they have a zero. If they have a negative, it's a credit to them for that rate. Over here, where you see 3.75%, that means that for the regular par rate that someone over here would get for no points, they were being charged almost 4 points to get a rate. That is to get a rate. Like I'm not talking, we see the normal span where you can get some with a credit or some at zero. If you had a 620 and you were putting a little bit down, it was really, really expensive. And that made it more difficult for those people to buy. So now we look at the new ones. And this is the way that this looks is these are the actual numbers and it shows the trend if it went up or down. Yes, Liz.
Just to clarify,
Yes.
first of all, 2 questions. One is, what does LL stand for?
Great question. Loan level pricing adjustment. So a loan level pricing adjustment is essentially an adjustment made to the interest rate based on the perceived layer of risk by the investor.
And the second part of that,
Yes.
with that chart we just had up, back to what you're trying to say is that in the case of someone who had low down payment and low credit, they had a points built into their loan and therefore it became extraordinarily expensive.
Exactly.
So this that we're about to talk about in reference to have to do with making it more affordable for those people.
Yes, and we'll get into that kind of the overall picture of it for sure, but you're definitely on the right track here. And one thing to touch on, the LLPAs are not just credit down payment, it's everything. It's property type, it's income type. I mean, it's basically all factors of the loan go into the pricing adjustment. This is just the most common and the easiest to understand by the general public, so we focus on this one. But like manufactured homes typically have a huge add to the rate. Condos have a big add to the rate. Single family residence, those don't have an add to the rate. So, but with the new one here, basically what you want to look at is if it's green, it got better. If it's red, it got worse. So it is true, if you're putting less down, the rate is relatively less expensive for you to lock that in, regardless of your credit score. So here, instead of paying 3.75 points, now they're paying 1.75 points. So they're still paying a pretty significant amount, but less than almost 4 points. It's almost 2 points now. Now, here we are seeing a little bit of an increase, and this is a fun little one. It's a heat map that shows what the actual change was. So this area right here got hit the hardest. It is true that the design behind this was by Fannie and Freddie, FHFA, to increase affordability for those who had a harder time before. So those who had lower credit scores, those with lower down. I mean, before you were paying quite a bit, even if you had good credit, if you had 3% down. Now you are still seeing, again, a relatively high amount of points. It's almost 2 points still if you're down in 620 and 3% down land. But over here, instead of paying the 725 FICO score, instead of paying half a point with 15% down, now they are paying, let me change the, and now they are paying 1.25 points. So 3/4 point higher difference. And the way that breaks down in real people numbers here is, let's say we have a $600,000 home. Couple of different scenarios. Obviously, again, we could go all day long comparing the differences here, but I want to show you what a 100-point swing looks like here. 725 FICO score, 15% down. The old cost to lock in a rate would have been about $2,500. The new cost now is about $6,300, $6,400. So they have the biggest hit here. They're putting that higher amount down, and they have relatively high FICO scores. They're paying about $4,000 more. However, it is still lower than if you had a 620 FICO score by quite a bit. Yes.
So what is the rationality here by trying to encourage someone to put less down? We didn't have a problem in 2008 because people did less down. How is this sensible?
It's not necessarily to push them to do that. It's just making it easier for them. Not necessarily, it's just making it easier for them. But the reason, and so these other ones, obviously you have a $1,500 savings if you're putting less down. And if you're over here, you have substantial savings for those who only have 3% 620 FICO scores to purchase. I mean, they're saving almost 11 grand and get 10 grand. But the reason that they would still put more down, they're not necessarily pushing everyone to do that. They're just figuring more people have more equity. People are going to be selling their homes, buying other ones if the time is right and life is moving that way, or they've been saving for that down payment, right? And what they are hoping they will do is still have that equity. They'll still put them more down because they're going to have a lower payment. This is a comparison between a 15% down 720 FICO and the 3% down conventional. They saved $728 a month by doing so. So the only cost for the rate here was the only cost there was about $6,000, $4,000 difference. But they're still saving $8,700 in the first year. So net, it's still about a $4,000 savings.
So,
wait, this one?
Yeah.
Yeah.
So it's the mortgage insurance only, but that
The principal as well. Close. It's in the principal and interest as well. I mean, that's almost a $500 difference right there. So you see here, well, there's a 1.5 point cost here versus a 1 point cost. That's a 0.5 point difference. But you're still saving, I mean, yeah, almost $250 in the MI alone, and then another $500 right here. So that's where they come out and they're saving $730 for a month. So it still makes sense. But the way they're looking at this as people still want to have a lower payments, they're going to put more down and they're going to essentially capitalize on that. I'm not necessarily agreeing with the rationale. I know. I'm just explaining what based on what we are seeing here. Because what they did, you may remember in 2021, was they first came out and said, we're going to charge everyone getting a refinance 50 bips. You guys remember that? Where we said it's now a 0.5 point more to do a refinance. Well, NAM and all the other heads of mortgage lenders came back and said, no, that's not cool, because their goal was to charge the lenders, and the lenders said, well, we're just going to pass this along to the refinances. So then they came back and said, okay, scratch that. We're going to charge everyone buying a second home and an investment home up the wazoo. Yes, so basically what they did was lower that a little bit and offset it with those putting that amount down. It's not a perfect plan. I will definitely say it's got its flaws.
So what's that?
Towards programs to help to hopefully offset lower income, down payment assistance, federal programs, something like that.
I can't say that.
One of the shows that I watch is called the National Real Estate Post, and it's used to be two guys, but they kind of split off, and now it's a guy and a girl. And
they did a great interview with David Stevens, who used to be the head of FHFA. Unfortunately, in our world, we can't, there's only 26 letters in the alphabet, and I think the lenders only know how to use about 4 of them. So it's not FHA, it's FHFA. That he was head of, and he did a very interesting talk. It's about 20 minutes long. I'd be happy to email you the link to it so you can watch it, but it goes into the political side of this that we're trying to stay out of. But it is very political as to why they did it. The other thing for you guys to remember is because they did this, a lot more people are going to get better pricing, especially if they're 700 and below FICO. They'll now get better pricing by going FHA than they will by going conventional. So as a listing agent, when you see those FHA offers, don't think this is not as qualified of a buyer, because there may be reasons from a lending side where it's just better for them to do the loan because it's financially better. But what they try to do, think of it as the Robin Hood effect. They're going to rob a little bit from the rich and they're going to give a little bit to the poor to try and make housing more affordable for all. In Dave Stevens' interview, he said he wished the director, it's the lady that had the power to snap and make this happen. He wished she had just come out and said, this is why we're doing it. Instead, she kind of danced around and said, no, we're not doing that. Instead of just saying, yeah, this is what we're doing. And then people would say, all right, I agree, I don't agree, but I understand. So I thought it was a very interesting 20-minute. So like I said, we'll send it out to you guys so you can all watch it.
We'll include that with the reporting and slides and all that stuff.
And then the other thing to remember is when I'm talking to clients, when Tyler's talking to clients, depending on the level of my clients, I could get, if I have a sophisticated client that's like asking questions like what Liz is asking, I could go deep with this, okay? I could tell somebody, you know what? You want to get the best pricing? Great. Let's put down your, maybe they can't do 3%. You have to put 3% down. You have to be a first-time home buyer.
Right.
So that they're really trying to help the first-time buyers, which is why the 3% gets better pricing than 5%. Okay. But you want to get real sophisticated? Great. Let's put a lower amount down. Let's get that mortgage insurance. That may be a better price, a better payment for you. And then you want to be tricky? Pay your loan down a little bit. So if you pay your loan balance down, that mortgage insurance can drop off.
How fast?
I think if you're paying it down, I don't think there's a time frame. Now, there could be certain time frames that can cause us as the lender an EPO, an early payoff penalty, if they pay down more than a certain amount. And I'll always, that's another thing that they came out with many years ago, back when Dodd-Frank came out, is they said, oh, prepayment penalties are illegal. So then what did they do? They said, okay, lender, if your client pays off a loan, we can't charge them the penalty, we're going to charge you. The people still not fair. They didn't care. So a lot of times, we get a penalty if the loan gets paid off before they've made their first 6 scheduled payments. You can't pay 6 payments on the same day. You have to pay them as they're due. So you'll hear us, we'll tell our clients that we know their situation. Like, here, we're going to help you structure this for the best for you, but please do us a favor and don't prepay that much on your loan. If they pay more than 20%, they'll come back and hit us. So help us help you. And you know what? Of all the times that I've done that for people so far, I haven't had anybody that's come back and caused me a prepayment penalty because they recognize we're trying to help them.
I know a lender who told one of my clients, we only do 6 months and over, you can't make payment. You can't pay off before that 6 months. So I'm like, that's a lot.
It's totally a lot.
Is that illegal?
Oh, it absolutely is illegal.
Because it's a big
So,
famous
yeah.
lender, and I was really pissed off, and I'm like, I hope you pay it off early.
Yeah, I had a client.
It's here.
I had a client, this was several years ago, who they bought a house before they sold their house. And when they sold their house, I knew they were going to pay off the new house. I mean, it was an older couple, that's what they were planning to do. And I said, okay, I don't want to charge you points, it doesn't make sense. Like, in fact, this was back in the day where we could actually get credit. So we covered all their closing costs, but I said, please don't pay it off before you've paid your 6 payments, because the penalty we get is often more than the commission we earn, which is a double whammy. Because if we do it where we're covering the costs for escrow, title, appraisal, all the other fees. We get charged back all of that, but I didn't earn that, I had to pay that out. So we put this nice couple into their new home. And the saddest thing of all happened, the husband committed suicide in the house before they moved in. And right after, the wife had the house painted like a flippin' Easter egg. So each room, this was in like Sun City area, each room she had painted a different pastel color. And then she says, I can't live here. And I said, I don't blame you. Like, you lost your husband. I don't care about my commission. Sell your house. And, this is where you do the right thing and the gods smile upon you. And because she painted her house so beautiful, nobody wanted to buy it. And her agent kept saying, you need to paint your house white. And she's like, I don't want to paint. I just painted. It's beautiful. She's like, you need to repaint the whole house white. And she says, no. And it was in a market when it took longer to sell, and my EPO was going to come up the day after, the Monday after Thanksgiving, and they were scheduled to close the Wednesday before Thanksgiving. And you know what? I didn't get the EPO. So, and they did close before Thanksgiving. So that was, do the right thing. But we'll explain this to clients. Again, some of my clients, I'm not going to go into it because I could tell that they would go right over their head. But if I get somebody that I see is getting it, we'll get into the weeds. Let's do a little bit of mortgage insurance. You'll get a better rate. And that mortgage insurance is going to fall off. And if you don't pay the loan down for the mortgage insurance to fall off, you can get a new appraisal after 2 years.
So it would make no sense for them to do an FHA loan with more down payment, because then they would be charged. Versus a mention.
Not necessarily. Every situation is different. The disadvantage of FHA loans is the mortgage insurance does not. But if I've got somebody putting down 3.5%, 5%, they're gonna have that mortgage insurance for a while anyways. So I'm not worried about that part of it, because we still believe that interest rates are gonna drop. People are gonna have the ability to refinance. We'll get them out and get them into the better loan at that. Sorry.
You're good. So really quick on this, we have a lot of other stuff to go over. What they could also do if they're putting that more down, they're probably going to be able to refinance in about 12 months when rates are expected to be a lot lower, versus the person that puts 3% down. They're probably still going to have the mortgage insurance unless they're savvy and can put a large chunk down and get themselves to do a better decision. So, okay. So basically, in summary of these LLPA changes, this is what it looked like before. If you had strong FICOs and higher down payments, low FICOs, lower down payments, small hurdle, big hurdle. This is what it looks like now. It's a little bit more even. Is essentially what they did. So, okay. The next pain point here, higher monthly payments overall. Obviously, interest rates are a huge factor in that. In fact, recent surveys came out and said that millennials represented 43% of buyers last year. Almost 50% of the surveyed millennials said that higher rates were a significant barrier to homeownership. 81% said they wish they bought before the rates jumped. And 53% of them now think they cannot afford a home. So it's our job to at least get them off the fence so that we can show them what options they may have. Because, truth be told, not everyone's going to qualify in this market, but they can at least figure out where they are. And then we will know, okay, we need you to be at a 5.5%, whatever the case may be, in order to move forward. So one of the things that we can do to help offset that affordability, I know we've talked about this before, so I won't spend a whole lot of time on this, is a temporary buy down. We're looking at a $600,000 home with 10% down at a 7% rate, just kind of a made up rate to keep numbers easy here. They are going to save almost $700 a month for the first year. So as long as they qualify for that higher payment, they can get $700, and the seller is willing to pay $12,600. They save $700 a month for the first year, and then the second year they're saving $350 a month. This works really well for our teachers who move up in pay grade, military who move up in pay grade, those kinds of jobs, or just someone who wants to ease into that payment. This is a really, really cool way to do it. Again, they don't qualify at this lower payment. They have to qualify for the larger payments because we're assuming they're going to keep the loan for the term. So the way that the credit works is the seller credit goes towards the servicer. Servicer basically says, Jeanette, I'm gonna take your $28.99 each month, and then I'm gonna take $700 out of that account to offset. So they're getting the same amount, doesn't matter to them, but the seller paid it upfront. The really cool thing about this is, let's say in 8 months, they decide they want to refinance because the rates have dropped, they've got a tangible benefit. That $7,000 that's remaining in that account is gonna go straight towards their principal. That's gonna cover, I mean, as long as they refinance pretty much before like here, that's gonna cover their fees for the refinance. And since they're buying in this market, we're most likely going to be covering some of the lender fees as well. That way it's easier for them to do so and to help entice them to purchase as well. I look over to purchase to make sure because they make the money decision. So. Now the other way we can do this, and this is where someone doesn't qualify at those higher payments, they can't do the temporary buy down, is a permanent buy down. We can use that seller credit to buy down the interest rate permanently and or the mortgage insurance. So this is a $600,000 down, 3%. Normal, no special buy downs here. They're paying $77,000 for the purchase, and their payment's $4,500. Now, if we up the price $15,000, ask for a $15,000 credit, they're coming in with $2,000 more. Their payment is almost $400 less. That is huge. That can be a make it or break it for someone getting into a higher purchase price, being comfortable with that payment as well. So that's something to keep in mind. I know it's getting a little bit more difficult to get credits, but if you can find the ones that they're willing to work with you and get that for you, this is a really cool option for them because again, they will qualify the lower payment, unlike the temporary buyer. Any questions on any of those options? Yes, Alan.
Do they need the full permanent buy down cost from the seller, like the temporary?
Great question. They do not. So let's say they've got 8,000 of it, but they don't want to use any more, plus what they already have here, but they have an extra $8,000. They can ask for 7 and get part of that covered. They can ask for just the MI to be bought out if they want to go that route. So it just depends on their situation. Awesome. Any other questions? Perfect. So the next pain point here is the down payment. We saw that in spades because of how many people we saw coming out for the Dream for Some program. So the down payment assistance options that we currently have available, you're looking at a total cash out of pocket that's 2 to 5% total versus 3 to 5% plus the closing costs. So it's still a very good option. We have options for first-time home buyers and non-first-time home buyers. It's just a little bit more expensive if you're not a first-time home buyer. The terms are more favorable that way. CalHFA will allow a 2-1 buy down as well. That's how we were able to get that in for the Dream for Some program. And you can go up to 50% debt to income ratio if you are 700 or higher FICO score. This is a relatively recent change. So we're really happy with this one because 5% can be a pretty big difference in someone's purchase price range. We do have options as well for non-occupant cosigners. CalHFA made a change a couple years back. They do not work with down payment assistance clients who have a non-occupant cosigner or who are not first-time home buyers. If you're on a CalHFA loan, have to be first-time home buyer, have to live in the home. We have options that work for mom and dad that want to help their kids out. An influencer who doesn't report their income, something like that. I've seen those. It's weird. Single-family residences, condos, townhomes, and manufactured homes are allowed. That's something that kind of gets looked over. Manufactured home is a really cool one because normally there's a really big hit because of the type of property. There are no LLPAs when it comes to down payment assistance. If you qualify, that's the rate that you get. So very, very cool feature of those loans. Sometimes it actually makes more sense, even if they have 5-10%, to look at down payment assistance because they don't have to spend extra for the rate. So just something to keep in mind. We've worked that on a couple condos even too. Okay. This one, we're going to start getting into some more theoretical type things. They don't want to give up their low rate. Does anyone want to throw out a guess of how many mortgages as of the first of this year started with a 2 or a 3? Any hands?
As a percentage or as a number?
You already know, as a percentage, yes. So raise your hand if you think it was more than 40%. Raise your hand if you think it's more than 50%. Keep them up if you think it was over 60%. It was 63% of mortgages started with a 2 or a 3. So that's an incredible number. for looking at a nationwide event that we basically went through, trend that we saw. So. Recent survey, April 17th, 82% of those looking to buy and sell feel locked in to their home because of the rate. That is huge. How do we address that? That is so much inventory sitting there because they're just afraid to get rid of that 2%, 3%, whatever the case may be. We tap into a couple of things. First off, September 3rd, 2020. 55% of homeowners regret taking out a mortgage during the pandemic. 2022, 75% of recent homebuyers have regrets about their new home. They feel trapped, they don't like it. It's not that they just feel like, oh, we can't move because of the rate. They feel trapped and they're not happy. So that's where we need to come in and figure out what their pain point is and how we can help them with it. One of the really big things right now, credit card debt is at a astronomically high and historically high level. Using the equity in their departing residence, they can eliminate those debts. Maybe they took out some cars and they can still put down a relatively high down payment to buy that next home, help offset their total monthly payments. So those who refinanced as well into a 10, 15, 20 year, which there were a lot of people who did that because they would get, I had a guy calling in January 21, and he told me if I couldn't get him a rate in the ones with a 15-year loan, he was leaving. And I'm like, I'm at 2.1. And he's like, bye. So there are a lot of people who got into 10, 15, 20-year loans. They will not feel the change as much if they go to a 30-year loan. They have to be okay with that. Some people just don't want to pay that much interest. We get it. But if their goal is to buy a new home, they have to figure out what's more important to them. Paying that loan off right now in another 12, 13 years, or buying a new home that they actually love, and then when the time comes, refinancing it into that shorter term, and then still paying it off. So have a little bit of a scenario here because these are actual numbers that could work for someone. The Baggins family refinanced their home with a 15-year mortgage in 2021. Their principal and interest payment plus their mortgage insurance payment is $3,250. But the Baggins family also racked up $20,000 in credit card debt, going on some adventures, and bought a new $30,000 car. Now they have an additional $1,000 in payments on top of that, and that's just principal and interest. We're not factoring in taxes, insurance, assuming that's going to stay relatively the same here. So the Baggins family also decides that they are ready to settle down and start raising a family, but their 3-bedroom, 2-bath home is not large enough for them. So they decide to sell their home for $610,000. They net about $150,000. They pay off the $20,000 credit card debt, what's left of that $30,000 car loan, and they put 5% down on a $650,000 home that has extra bedrooms, possibly even a small pool or a spa for them. And now their principal and interest payment is just over $4,200. It's lower than what they were paying with those other payments, and they're able to keep about $50,000 in the bank. So it's debt consolidation. It's just utilizing that asset that they were smart enough to purchase when we encouraged them to put themselves in a better position moving forward. So obviously this is not everyone's scenario, but it at least helps get them thinking, could this be me? We've run credit for people that want to buy a house and they've made, really relatively low income and they have a $900 car payment. And I'm like, how do you manage this? Like, why do we have this here? If you have a $900 Mercedes each month, but you're telling me you can't afford a $3,000 a month mortgage, something's off here. But if they were to sell, or if they were to figure out a way to get rid of that payment and get a higher mortgage payment, that's going to be better off for them as a holistic environment. Yes.
I heard that we're rolling out a 40-year mortgage.
Great question. Great question. So we'll touch on that a little bit. Steal my thunder. I'm just kidding. The 40-year mortgage is not a thing for purchases. It is a thing for modifications.
Oh,
So
so you have to be late on your payment to get the 40.
yes, so we'll talk about that. Basically, we think they're gearing up for if one of the things on the back end, on the hard data, so to speak, is they are anticipating that the jobs market and the services market must fall before things start to get better on our end before the true recession hits, even though housing is the first to feel the recession. They're expecting as an entire economy, we will not be in the recession until wages fall, services fall, and jobs are lost. And I believe the words of Powell a few months ago, there needs to be more pain, was pretty much what he said. So they are gearing up. FHFA, Fannie, and FHA are gearing up for more modifications because they think more job losses could be coming. So just something to kind of keep an eye on, but of course we don't want to freak everyone out. And who knows, if we had a crystal ball, none of us would be doing this, right? So the next part I want to talk about is we've given some examples of what their issues are, how we can help them holistically be in a better position. How are we going to generate these leads? Well, what do we do in down markets? Any suggestions? Compared to 2021, when we could hop online, see 20,000 new Zillow clients that wanted to see our listing, and call them up and ask them, if you're not $70,000 over asking price, don't even bother. What do we have to do now? We have to work. Yes, we have to go back to basics. So buyers and sellers alike are generally uncertain and very skeptical of the market. It has been proven when we enter times of uncertainty, people are generally mistrusting. They think that what we're telling them is in our best interest. And we all know, everyone in this room, we are acting in their best interest 99.99, no, 100% of the time, actually, not even 99%. So what can we do to help them understand that we are here to help them? And educate and be there for them. We can be the experts, show them our expertise, help them understand what these smart moves are to make in this economy, in this situation, and how they can benefit, and also tell them, you know what, you're right, this just is not the time for you. Keep renting, keep saving. You know, people make $4,000 a month, and that's their only income. Their best bet's a $2,000 a month payment. That's not going to work out here. So there are those people, but it's giving them that advice and helping them, because also those who are not in a good position, they will remember that more than those who were in a good position and you helped them buy. And they will refer their friends and clients, or friends and family, because they know that you will take care of them. So, good old Teddy Roosevelt saying here, no one cares how much you know until they know how much you care. So, we go back to basics is what we're going to do in this market. Reach out to your sphere. The first thing we want to talk about is video. I know a lot of you in here are doing really well with video, so keep that up. I'm not here to hammer you on this for this talk. This one is focused on getting people off the fence. We can do another social media one at a different time. Client appreciation events, just another way to give back to them, show them that you care and be there for the community. Christine, I know you just did recently a community garage sale. And what did they tell you when you met someone at the door who was actually wanting to participate?
They were just there, thankful, they appreciated it, and afterwards they, you know, it was nice. They didn't have to get up, about the signs.
And they appreciated that you were doing that. Time and time again, thank you so much for putting this on. Do things that can garner that, just to show your community you are there and you are their local expert and liaison. Yes.
I remember Kim Meeker, who's now really big. She started farming her neighborhood when we were doing REOs. And you would think that it's not any good, but it's not, we're not working for today.
Mhm.
So she works and works and works. And now she's got the benefits of that. So
Yeah.
that's really what we have to do. We don't think about just now.
Exactly. This is a foundation building market. This is where we're going to build our businesses for the next 10 years. So don't be looking for the how quickly can we close, be looking for let's nurture you, let's get you in the best position possible. So the next thing here is to ask thoughtful and open-ended questions when you're calling them, when you're connecting with them. As I asked you earlier, what's the best thing that happened to you recently? No one said, oh, I'm good, right? You all had an answer for this, and we all started thinking about what's going on, and you started thinking about the good things that are going on in life, not just good, when you really wanted to say, well, stuff like crap, and I need to get groceries and having a laundry and all these things. You started thinking for the good. Start getting people thinking of the good, Because the more that that's being thought of actively, the more that that's in their subconscious and the more that that comes out. So it's just generally teaching them to be a little bit more positive as we're going through times of uncertainty. What are you excited about? Again, same premise here. Ask them what's going on, but this one is actually a little bit more targeted. Daughter just had a baby. Great. Where are they living? Oh, they live with us. There we go. Exactly. How excited are they for living with them? No, they're excited because they're having a baby. You just graduated from college. Oh, great. So that 5-bedroom house you have, that was the last kid you had, right? That's another opportunity. Just find ways to connect with them and find out what's going on in their life. How is your family doing? Well, parents aren't doing so good. We've been going back and forth to LA trying to help them. Maybe it's time that they get a little bit bigger house and keep their family a little bit closer. Maybe they can try and get them into the colony or something like that. It's an opportunity for them to feel that you and see that you truly care about them. You're doing what's best for them and not just a way of, you want to know what your home's worth, because that just comes off salesy. Even though we're still trying to help them with that, it comes off the wrong way. Can come off the wrong way, as you said. Is your home still meeting your needs? This is getting into a little bit more of the actual direct question. You know what? No, I've got kids stacked up. I've got a triple bunk bed in one room, and okay, good. Let's start looking for something that's going to fit those needs. And be honest with them. A majority of homeowners feel trapped in their home by their low rate. How are you doing? How are you feeling? Open up those conversations, because guarantee you those emails that other realtors are sending out, the circle dialing that people are doing, it's not the same as reaching out and being the person that cares about them, the consultant that cares about them. And these are great questions to get them thinking and get them feeling more connected with you. So you tie those in with some more videos, talk about your life, what's going on, open up about your pain, open up about what things are going well, encourage them to talk about those things as well. Do letters from the heart as a video. Talk about what's going on in your life. Talk about the family that you helped over a video. Tell the stories that are going to help them feel better about what's going on and what options they have.
Tyler, is there a way to find out who has 15-year loans as opposed to 30-year loans?
Yes, I know Mary through Chicago Title has given, I can buy certain data. I did it for some target marketing to reverse clients, and you can drill down to like anything you need.
That might be something interesting to.
Yeah, partner with your title agents, ask about your farm, and start going around your sphere. And if they worked with us, we'll shoot you a list of the people that were 10, 20, 15 years that they refinanced into, and start working with those as well. Just starting the conversation. Maybe they're great. They love the house, and they're super excited that they've been making aggressive payments. They've got 5 years left on it. That's great. But they're talking to other people about how great they feel that they got 5 years left on this 10-year mortgage. But not all of them are in that position. So identify their pain and the goals. That is really the objective with those calls. Again, consumer debt is at an all-time high. Do they need to consolidate? Are they just, when they open up about it, are they just drowning in credit card debt? Do they need to send their kid to college? Oh, really quick. The average credit card debt APR, 24.24%. That is average. There are some that are 27, 29%. Mortgage is 7%, 6%. That's a lot lower. So do they need to consolidate? Do they just need to overall feel like they are getting their head back above water? Did their work shift back to in-person? Now they're worn down by their commute. God, I had to drive down to our summit. It was Thursday, Friday of last week. I had to drive back starting at 3 p.m. on last Friday. I got home at 6. That's 3 hours. How many of our clients are doing that now? They thought, this is great. We're going to move from San Diego because it's got 7 years. Yeah. Oh yeah, it's fine. We're good. We're on Zoom now. Not anymore. Not when they have 1 day on Zoom and 4 days back in. That's a long drive. And every single day, that's going to wear them down. They're going to start thinking, you know what? Escondido's not too bad. Or Orange County, they're going to start going back because it's time away from their family. It's time away from their significant other. It's money spent in gas that they could be spending on dinner and fun times, date nights with their family.
With the mortgage.
Or the mortgage, exactly. Yeah, we'll have to calculate, work up the numbers of the commute, and we'll say, so you're spending this much a month in gas. Translate that to a house payment.
And sell your Mercedes.
Exactly. Hybrid. Are they looking to upgrade to a larger home? Maybe they have a growing family. Maybe they're empty nesters, we talked about. Kids going off to school, they've got 5 extra bedrooms that they don't need anymore. And are their kids grown and looking to start purchasing? Now's the time if they're growing their family and they're living at home. Yes, that's sustainable for a little bit. But if anyone's done that with their spouse, significant other, and lived there for years, you know that's not a fun time. So are they looking for their own home? And maybe it's not now, but you're at least planting that seed so that when things turn around, they're in a better position. And then also, if they have someone going off to college, maybe it's time for them to look into selling so that they can help pay for that college rather than taking out a bunch of loans. I know the student loan environment's a little rocky right now.
Near the college.
And yeah, maybe they wanna,
Yes.
go be by their family and, not have to drive so far to Santa Barbara or something like that. And then you keep in mind who those people are, so that when you're up in that area, you have a place to go stay and give them one extra bed. So, want to ask a really important question, and this is one that was asked at our summit and really got us thinking. What business are we in? Not the answer I'm looking for. Anyone else? I know, surprisingly. What do we provide? What do we deal in? Happiness, stability, love, family. These are the things that we are selling. These are the things that we are providing. We are not providing the relationships.
I saw.
That's me announcing to some of you in the room, by the way. Serious? Thank you. So excited. Thank you, yeah, so. But, yes, oh yeah, so this is not. I be up against the wall. And then, so. Because these are the businesses that we are in. Yes, relationships, but what are we providing? We are providing these factors. We're providing them a place that they know that they are living for a long time until they decide to leave. That they have places to build memories, to build families. We have to keep those things in mind when we are talking with the clients. Going back to the basics again, you want to expand your sphere. So go for the D's. There are 6 of them. First, death. It happens, it's a part of life. Connect with trust and estate attorneys like Deanna over here. If you haven't talked with her, she's fantastic. Definitely get her card before you go. But that is a fantastic thing because do you need resources to help with people that need to sell homes and to deal with these things?
Yeah.
Absolutely. Exactly. Divorce. I know this is given. Connect with those divorce attorneys. Again, this is the time that we're building the foundation. Rates are not super low. They're not looking to move super quick. You have a little bit of time to actually chat with them. Degrees, empty nesters, do they need help paying for college? It's expensive and it's not necessarily going down. So that's a really good way to connect and help them with another need. I do's, chat with the wedding planners and wedding photographers in your life. And I thought about this. Wedding planners, that's one that we typically and stereotypically throw out there that, yeah, I want to talk with them. What are they doing during the day? They're running around with their head cut off, right? What's the photographer doing? They're with them the entire time, from the getting ready, from all of that. So they're going to be hearing more. They're with the bridesmaids as they're getting dressed. Oh, my mom and this and blah, blah. They are going to be the ones who are doing the guerrilla tactics here. The wedding planner, they're just focused on other things. I mean, yes, they can connect you with, yes, we have this client that's going to be moving or getting married. You should talk with them, but don't forget those people that are actually going to be involved on the big day. Dogs. I loved this stat. This is a recent survey as well. 89% of millennials who bought in 2018, not super recent, owned a pet. 89% who bought owned a pet. 79% of them said they would have passed up an otherwise perfect home if it didn't fit the needs of their pet.
Well, that makes sense.
Yeah,
really.
exactly. Now, how many
Yeah.
people? Raise your hand if you know someone who got a dog or a cat during the pandemic. They may need to reevaluate. Maybe that $1,500 or 1,500 square foot home is not enough for them. Diapers. Do they need to upgrade? Connect with doulas, ultrasound clinics, whoever's going to be around the people that you want to be talking to, get connected with them now, rather than when things turn and everyone's like, oh yeah, we're selling, we're buying. I mean, it's a madhouse in real estate again. That's when people are thinking top of mind. We are obviously deeper in the weeds looking for opportunities all the time. So these are some really good ways that while the market isn't necessarily booming, we can create our own booms. And the next part, handling their objections. We talked about some strategies that can help them with wanting to move, needing to move, who we can talk to, how we can find them. But ultimately, once you get them in your car and you take them to all these houses, you're going to be hit with a couple of things. I'm waiting for rates to drop. So is everyone else. This is where we need to coach them. These scripts, I'm hoping, will help you when you're chatting with them to be very direct, yet gentle and firm with them, letting them know I care for you and I'm your expert here. You need to listen to me. This is what's going on in the market.
Can I ask one quick
Yeah,
question?
of course.
So, and the next thing that everybody says is you can always refinance, but there are qualifications, right?
Yes.
Like everybody can't, that's such a pet peeve of mine. When you don't have equity in your house and realtors are saying, you can refinance. It's like,
Right.
no, you can't.
Yeah, and that's the thing, is not everyone can. So like the people that bought early 22, they're probably they're mid 22, they might be in a tighter spot right now, rates of future. Now, there are some loan types, we talked about the payoffs, there are some loan types that do not allow you to refinance with that same type of loan before your 6 payments are made. VA, FHA for a streamline, conventional doesn't necessarily care, but VA and FHA, you cannot do it until you've made your 6 payments. That's
So we
just.
should say you may.
Yeah, you may be able to refinance, and there's typically not much of a benefit at about 6 months unless things drastically change.
But you have to remember, like, if people are refinancing because the interest rates drop, they've just qualified for the loan because we have no more mirror loans. Those have been gone a long time. So if they qualified at the higher interest rates, chances are they're gonna qualify at the lower rate, as long as they didn't go buy the $900 car or trash their credit. The people that will have the biggest challenge are gonna be people that use the down payment assistance because they could be at 100% financing and they'll have to pay off that second. Or the people that are at 97% because their house values will have needed to go up. But for the majority of people, if they're putting down 5 or 10%, they'll probably be able to refinance regardless.
Yeah, as long as the rates drops significantly, you know.
Yeah.
And there's some people, they put 15% down, rates don't really change, but maybe they do need cash out. That's still an opportunity. They can go 95% if they need to. I mean, it's gonna be more expensive, but the option's there.
But you can't do 95% cash out.
No, you're correct, I'm sorry. It's, but, so that's 85%. So. But that's what our job is, not the.
Or FHA would allow it.
Exactly, so. But we're not training you guys to be lenders here, so. The rates are expected to start dropping in May and continue through the end of this year, potentially into next year. So. We have so much latent demand that a flurry of Facebook posts saying rates are dropping. Anyone remember that lovely little slew of, you open up Facebook and Instagram and all it is people saying rates have dropped, rates have dropped, rates have dropped. They dropped by 0.25%. It was like $50 difference for people, but mortgage applications shot up like almost 30%. So if basically an artificial drop and flurry in the market can cause that, what's going to happen when they drop significantly? I mean, when they are down 0.5%, 0.75%, a full percent, it's going to go crazy. We're going to see probably things worse than 20 and 21 because of the inventory. So the question to ask them when they say we want to wait till rates drop, would you rather wait and buy in the frenzy, offering $70,000 over asking price, possibly losing out on 5 homes that were the perfect ones that you fell in love with? Or buy now, refinance when the rates drop, and then capitalize on the increased value because demand has skyrocketed. That's gonna get them thinking. That's gonna take it off of the surface level. Rate is this. Get them thinking, oh, well, I may not have a house to refinance at that point. Or I'm gonna be buying a house that's tax basis is way higher because I had to offer a whole lot more and I wasn't able to get a concession for that temporary buy down.
I have a quick question, I'm so
Yes.
sorry, but with the refinance, because you want to make sure that you're doing it right. So when you're telling somebody about that, would you tell them, because you said something about they shouldn't buy the extras, things, what do they need to do to get that? That should they not buy like a car or, what are the qualifications, just like we tell people when they have a loan, don't buy anything until after we close.
I mean, they're essentially the qualifications are the same. They're different depending on the type of loan you're doing, like a cash out or certain types of loans, but we have most of the time the same ratios that you're looking for. So yeah, if they're looking to, if they bought the house, then they go get, 2 Teslas and they get solar to, on a loan so that they can charge those cars, they're gonna have a harder time refinancing because their debt to income, or they could, because their debt to income is
So
gonna
we
be
should just
higher.
let them know that, they're getting big
Yeah.
purchases.
We tell people that, like Liz and I are working with a client right now whose ratios are super, super tight. Better, he wants to refinance, we had to go FHA because. We had extenuating circumstances, right? We went through divorce. So what happens when people go through divorces sometimes? They don't work as much overtime because their income determines their alimony. So he didn't work as much overtime. So now his debt ratio's higher, so he had to go FHA, but he's got equity in his house. So in 6 months after he's made his 6 payments, I told him, keep working overtime and then we'll be able to refinance him. And he won't have that FHA mortgage insurance. And he's got more overtime, so his income will be higher. And hopefully he'll be in a better position to be able to do that refinance. That's coaching that we give them as well. So, but yes, it's always good to tell your clients, if their intention is, I'm doing this, but I really hope I can refinance. Then the more people that are reminding them, don't go buy other cars, keep making your payments on time. Do not listen to the media and go out and lower your credit score because you think you're going to get a better rate, because that's not the case. So
Yeah, essentially keep the profile as close to the same as possible when you're trying to make those decisions. It's the same thing when people ask, how long is my pre-approval good for? Technically 60 to 90 days. But in theory, as long as the situation stays the same, your credit doesn't change, you don't run up your credit cards, your income stays the same, you're pretty much going to be, we'll update the approval, it's pretty much going to be the same thing. So
as long as the program doesn't change.
Yeah.
If the program changes tomorrow, it doesn't matter if you're pre-approved today. If the program changes, the pre-approval is no good.
like I said, the situation is just like. Okay, so that's if the rates, when they're waiting for the rates to drop. Well, then they say, let's say that we buy in May 2023. And we have the $660,000 loan amount, 6.5% interest, payments just under $4,200. Now, let's assume that by early 2024, rates drop to the mid-5s. Again, gonna push up those values, gonna push up the demand. Let's say we get a 10% increase in value. So now they're buying the same home with a $726,000 loan instead. That puts their payment just under, because the rates dropped, just under this 4171, they're at 4122. They save $50. Congrats. But instead, they could be refinancing their $650,000 balance at that 5.5%, and now they're at $3,700. That's a $415 savings, not including the lower tax basis because they already purchased the home. So, any questions on that? Cool. So the next one, well, I'm actually waiting for the prices to fall. That's that, we should just send them that basically, but since that would be considered rude, I'm guessing. They'll be waiting for quite some time. What leads you to believe that prices will drop? Where are you getting that? Oh,
The place are fair.
my
Yeah.
brother's uncle's dog said, what about? Exactly, yeah. Yes, and if any of you saw my first email invite for this, if we had dollars for every time that we heard that, no joke, we would be running our own portfolio loans here, but Exactly, yes. So, and in the last, forget how many decades it was, Connie, I think you had mentioned it was like the last like 5 decades in California, if you had owned your home for at least 10 years, you have seen equity grow. You have seen an increase in your value. Yes, we might be down a little bit here in our area, but you look at the rest of basically the last few years and now where we are now, it's going right back up. So, and these aren't short-term investments. These are long-term places to start building a family, to start building those memories. Inventory is still extremely tight. Builder starts and permits are still at extremely low levels, meaning we will not see drastic changes in our inventory anytime soon. That's just a fact. Permits have gone up. I had someone telling me he does manufactured homes he helps them put the manufactured home on the land. And he said in Wildemar alone, the cost went from $5,000 a few years ago to $55,000. Just to do the permits. Yeah, and so it's insane, the fact that it's just so much more expensive to get them going. That's not going to help our affordability, and that's not going to help things quickly either.
Plus with the manufactured homes, if you're buying them, it's like a 1 year or more wait list.
Yeah, exactly. So, and that means they can keep charging more. FHFA and FHA have started gearing up for potential modifications. This is to keep people in their homes. They don't want people to have to short sale, foreclose, and give their homes back to the banks. So that's not going to help inventory. People are saying, well, there's going to be a lot of foreclosures. There's not. They're trying to help them. They want to keep them in their homes. They don't want to add all those loans to their balance sheets. They will give them a 40-year loan and drop their payment $1,000 to get them.
These people have equity.
They have equity. Yes, I mean, we all know this is not 2008. You know, everyone had to buy with at least a little bit of equity. So we're in a relatively good spot, of course, just with luck here, but we are not going to see those values drop like people might be thinking. And when rates start to drop, the values are only going to go higher, as we mentioned. So are you willing to risk being priced out of the area? That's going to tug at a lot of heartstrings. Why are they even here? Schools? Be close to family? Are they willing to take their kids to a different district? Are they willing to commute even further for their job? Just some food for thought for them. Fine. Well, I'm actually waiting to save up for enough for a down payment. They're standing in front of the same house telling you all this, by the way. That's the scenario that went on in my head here. So the cost of waiting is steep. They need to remember that. And you need to ask them, how much do you think you need? Really, just question everything that they're saying. These objections are nothing but questions for you to answer. It's not them saying, I can't do it because of this. They're looking for you as the expert to say, no, challenge what they're thinking. So how much do they think they need? I've had my own friends. They say, yeah, you're doing loans, right? Oh, I can't buy, I don't have 20, 40% down. No joke, 40%. He's telling me he's going to use his dad's VA benefit. He doesn't have 40%. And I'm like, where do you get any of this? Like, that's insane. So ask them where they got that too, and then take note of that because it's just crazy. You can buy with as little as 3% down and even use down payment assistance to come in with less. Remember, 2 to 5% total is what some of them can qualify for. So again, ask the question, are you willing to be priced out of the area? This isn't a scare tactic, it's reality. People that wanted to buy in South Temecula that can only afford a $500,000 to $600,000 home, how many houses are there for them? Exactly. Case in point, are you willing to further increase your commute? Are you willing to take your kids out to a different school district? Harris Unified and Menifee are great. Are you willing to take them out if they had their heart set on running a Great Oaks track? Or if they had their heart set on playing Marietta Valley lacrosse? Maybe they've already started and they made friends there. Are you willing to take them out to a different area because you don't own in that area? You're not solidified there. Well, what about that Dream for All program? That was great. I'm going to wait for that to come back.
Dream for a few.
California Dream for some. They estimate about 2,300 locks were made for the program. We will see in about 60 days how many of them went through. That's how long they have for the loan to close. American Pacific Mortgage did 230 of those locks, and our personal branch, we got in about 1% of our company's production. So we're very proud of that because 1.5%, yes. Oh, is it over 1%? Yes, it is. I mean, and that's for it being alive for 7 business days. We'll take that.
Well, you guys worked really hard for the others that didn't.
And we had a lot of tough calls on Friday. That was not, get the email at 12. it was done over 24 hours ago, we're like,
my kids were one, and Kylie was awesome.
I didn't pay her to say it.
No.
So the dream for some, it could come back. It very well could. But the initial 300 million was used up in 9 business days. So while it could come back, how quickly will it go next? Now that everyone's ready, now that all these other lenders are having these conversations and saying, let's keep you ready. If you're probably gonna have a weekend to shop, if they even give us that long. If it comes on a Monday, oh boy, you're doing showings on Tuesday nights, Monday nights, you know, it's gonna be quick. So if that's the case, that's fine. We'll get you pre-approved. Let's see what you can actually do. We had clients come in, they had $70,000 to $80,000 to play with. And I explained how the program worked and they went, I don't want to give up my equity. Great, let's get you another program. And they did. So it got them in the door, and that's what's important about this. If they mention the dream for all, let's just get the conversation going. Fine, I'll talk with your lender, but I'm waiting for the perfect home. Okay. Good for you. So the good, the bad, the ugly, anyone know what I'm actually referencing here, not the movie? The good ones will, the bad ones won't, and the ugly will waste your time. So when you're chatting with them, we will do our best to find, and I know you guys have excellent scripts for this portion in particular, I'm sure. We'll do our best to find the one that ticks as many boxes as possible, but I need to remind you, this doesn't have to be a forever home. This is your first home or whatever instance it is. And if things continue the way that they are, staying here for a few years should bring you enough equity to move up in a few years. So find one that works for you now. Obviously, we're not just going to throw you in a shack where you have 5 beds and 2 rooms, but let's find one that gets as close as possible to that perfect. And then what are the top 3 things that you want in your home? Again, you might have a better script for this. If you do, let me know, because sometimes they even tell us what they want in the house. And I'm like, I need to know numbers. What can you qualify for? $1,500. Okay. So what are the top 3 things you want? And of those, which is the most important and which could you live without? And it's important that we say wants. Of course, I know we ask for wants and needs, but if we address most of them as wants, puts that in their mind that, you know what, maybe that isn't necessarily a need. If you keep calling it a need, well, I'm not buying it, it doesn't have it. So figure out what 1 or 2 are the needs, possibly 3, depending on how flexible they are. Can't talk to them. And go from there. I would hate to see you miss out on this market just because a want wasn't being met. Just remind them it's not a scarcity thing, it's not a scare tactic. It's that this market is going to move relatively quick when things change. Even now, rates are still high and you're still seeing multiple offers over asking. So what's going to happen when the rates do drop and the values don't drop and the inventory is not changing? They have to keep those things in mind. So again, keep in mind, not everyone will be ready. It's just a matter of fact. I've talked to so many people and I just explained when things are getting to a certain level, it might be a different conversation. If you can add some family members in, that might better your situation, but it's not for everyone at this point. They can't do it necessarily yet, but stay on them, because as we talked about earlier, if you're dismissive, they will remember the people that, and when they talk to us, like, oh, well, this lender just didn't have time for me because I've got low credit. And it's like, you've got a 639. If you pay this $500 card off, you can have a 650. And they're like, oh, cool. They remember who was dismissive, who didn't want to help them. And they especially remember who helps them when the others wouldn't. That's how we gotten a lot of our clients. I'm dubbed the rock pusher in our office. And I've gotten clients in who, frankly, probably would not get in with another lender. It takes a lot of time and a lot of effort, but they remember it forever. So a very short summary, because I know we're a little over on time here. Find their pain point, you'll find your solution. Show that you care, because they don't care how much you know until then. And remember what businesses we are truly in. I know we say we're in the relationship business, that's our business, but the business that we provide, the thing that we sell, think about it, we're Disneyland, we're McDonald's, we're selling happiness. What does McDonald's say? It's a happy meal, and then they give you a Coke. And what does Coke say? A Coke and a smile. Like, it's all about the happiness, the stability, the love. That's what we're bringing them. Educate them on the market. Show them what's going to happen, what's going on. We are the experts. You have to give them your expertise or someone else will. It's a matter of fact. Objections are nothing but questions for you to answer. And who made up 43% of the housing market last year? And what percent of them would pass up on an otherwise perfect home if it didn't suit their set needs? 79%. I just thought those were really fun stats. So keep that in mind when you're talking with your millennial friends, talking about their new dog. It might be a great opener from there, but of course, remember all of the other openers as well. These are going to be the ways that we build the foundations for the next 5, 10, 15 years, helping the clients that may not otherwise qualify, helping their kids start the conversation about this, and just being there for them. Any questions? Well, that is pretty much all we have, and thank you so much for joining us.
I would have been right on time if I hadn't checked in for you.
We won't go there. But we do have a couple of things for you. We do have our survey here. Those of you who have been with us before, which is pretty sure everyone here, we really appreciate the surveys. We take them very, very closely to heart, and we use the feedback to better our future events. So if you could give us your honest feedback, everyone that responds by, we'll say the end of Monday this time, they will be entered into a raffle for another prize. So we appreciate that. And then we have one actual live raffle here that we will give off for a thank you for being here. The cards are all sticking together. I think I have one. Pazna. And hopefully you're a reader. Good. Have you read that one? Okay, good. So that one, I highly recommend it for anyone that hasn't read it. There's no plan B for your A game. I won't spoil it for you, but it is essentially about exactly what it sounds like. We are professionals in our industries. We are not fly-by-nighters. We are not the random agent that can't talk to you between 8 and 5 because they are working their office job. We are the people in the trenches. This is what we do every single day, and we want to be the best to give our clients the best. And it's all about building that long-term plan. These markets are what builds our future business, is the foundation. That book is all about building your foundation for the next 10 to 20 years. So highly encourage you to read it. I'm almost done with it now, and it's really, really good. So, and thank you again so much for coming. I really appreciate it. Thank you. And hi, Trisha. If you're still there. Were there any questions, Grace? No, okay, good. We'll turn this part off, and please take bagels and coffee because, again, otherwise, I mean, I love bagels, but. Huh? No, they're not. They are not.